Same, I cannot share the video. I can share my screen. I can't share my screen either.
Now?
Yeah. There you go. Technology. All right, can you see my screen, Brenda?
Yes.
Okay, great. I guess we'll have to give people a few minutes for them to rejoin.
Yes. Okay. Welcome, everyone. We're going to give a couple of minutes for people to join. It's 12:06. Thank you, everyone, for joining. We're waiting a couple minutes for more people to join.
So everything seems to be working now, Brenda. I guess the video,
Yes.
the presentation.
Everything is, yes.
Great, great.
So what we can do is we can start now. What do you think?
Sure, let's kick it off. Yeah, let's kick it off.
Okay. So welcome to our webinar. This is an introduction to residential real estate investing. I have the pleasure to introduce you to our speaker today. My name is Brenda Boral with Oral Agency. And today we have the pleasure to have Ben Plouvier as our speaker today in our webinar. Ben is the founder and managing broker of HNB Realty. He has been a real estate entrepreneur and investor in the Houston Metroplex market since 2008. He has more than 15 years in real estate investing. He has more than 100 real estate deals done. He has more than 40 returning clients. This skill set has led him to consistently deliver superior cash-on-cash returns with his client base. Welcome, Ben, and the floor is yours.
Thank you, Brenda. Thank you. Well, over the last couple of months, I've had a lot of questions about residential real estate investing, specifically. A lot of people asking me, how do I get into it? How do I navigate this market? That seems to be tricky. And it's true, it's more of a seller's market, especially on your regular home in the suburbs or close suburbs. So, and all the news, of course, of prices going up. Is it still good to invest in real estate? So Brenda and her team suggested we should do a webinar. I think it's a great idea. I don't see the chat, so if you want to go ahead during the presentation, put in your questions. Brenda's going to collect them. If obviously they're relevant, she'll stop me throughout the presentation and we can address those. Otherwise, we'll have some time at the end There's only a few slides. It should only take 20, 30 minutes to review some of the basics, and then we can get into your questions. So what are we going to talk about today? Well, before we do go into the topic, with just a few little disclaimers. All the materials and numbers that you will see in this presentation, they're based on our own experience, our database. So it's our proprietary numbers of deals we've done in the past. And you'll see some of the deals span over 12, 13-year period. We're not soliciting today any sort of sale of an investment or security. This is just for information, just to get some of these questions answered that we've had over the last couple of months. If we do discuss forward-looking statements, and there's not really any forward-looking statements, those are just projections, and obviously they're not guarantees in any way. All right, let's dive in. So today we're going to start from the basics. What is a residential asset? And we'll look at the different types. Then simply put, how do we make money in residential real estate investing? We refer to those typically as the 4 wealth generators. We'll look at those. In third is, once you have that understanding, you need to know how to evaluate deals pre-acquisition. And there's 3 main metrics that I always want you guys to have a look at and review. And last but not least, we'll look at some of the most common strategies to start investing, and we'll show you some actual business cases of data that we've had in the past. Can I get rid of this? No? All right. Well, before we kick it off, this is a very famous quote by Andrew Carnegie. Real estate investing is as old as time, and I do think his quote was very powerful. 90% of all millionaires become so through owning real estate. More money has been made in real estate than any other industrial investment combined. So it's a true and proven way, real estate, to acquire wealth and grow your wealth. Also a very true, proven way. I don't know if I can move this. Sorry. Brenda, do you know if I can move this, or is this seen by others?
Yes, that's what is seen by others, and you can move it.
Okay, let me try and move it a little bit here. Just put it on the bottom here. Yeah, so this is a true and proven way to access wealth, and is a very powerful statement. So let's dive in with the first slide. What is a residential asset? Ooh. I see myself now. Wait, there you go. What is a residential asset? So I mean,
you need to share again. You lost the share
again. Okay. Sorry about this.
You press something.
Did I press something?
Share your screen again.
Host disable the participants say screen sharing.
Can you do it now?
And I can, yes, I can do it now. So look, there you go. Wait.
I don't know what happened there.
Wait. Oop. All right, there we go. So residential is something designed for people to live in. We typically have 3 types. The first one is a condominium. You'll see here at the bottom left, we had included a little picture. A condominium is an ownership of your walls in of the unit, and then you share in common the land and other features with the other owners of that project. So, you know, think of a swimming pool, a shared driveway, a shared gate, for example. So other features that are owned in common. So we'll refer to that as a condominium. Typically, you have association fees with a condominium, which you can also have association fees with single family homes, but those will be a little bit higher typically because there's maintenance of the common areas. The second type of asset is the single family home. So you own the land, you own the improvements in a fee simple manner. And the last type of asset is what we refer to small multifamily. So small multifamily, specifically for residential, are going to be duplexes, triplex, and fourplexes. Anything above 5 units is considered a commercial asset. So here on the right, we included a picture of what a duplex is. As you see, it's an improvement with 2 units there. In the lingo, some real estate investors may talk about small multifamily, and they'll refer to something below 20 units, but they're sort of referring to an asset without distinguishing if it's residential and commercial. But anything above 5 will require a commercial loan, so it becomes a commercial asset. So guys, I guess you tell us in the chat, what sort of assets do you own currently? What you think, what looks good to you? What's an asset that you would like to own? A small multi, a duplex, a single family? There's advantages to some and both of them, and we'll have a look at that in the presentation. But go ahead, share your comments on what you think about the different types of asset. On next slide, we are going to talk about how do we make money in residential real estate investment. There's basically 4 ways we make money. The first is what we refer to appreciation. So you might have heard the term that real estate is a hedge against inflation. So that's because of the natural appreciation. There's a direct correlation with inflation. So once you own a piece of real estate that is residential, it will appreciate in correlation to inflation. There's other drivers that influence it too. Population migration, because it's a demand for lodging. Jobs, there's a correlation to that. So you've got this natural appreciating factor, which you don't have, by the way, in commercial real estate. So if you own an office building and you purchased that 5 years ago, today it's worth less money than when you purchased it, because it's a correlation of the cash flow it produces. The other appreciation, we also refer to it as forced appreciation. So that's when we intervene on the asset and we'll improve the asset. We add a bedroom, we update the house, we add improvements, and we force appreciate the asset up to the highest and best use of that asset for that area. The second wealth generator and how we make money, and a lot of people are interested in that, is it's a cash flowing asset. As a landlord, you receive rents on a regular basis, and that creates a passive stream of income. It's very much of interest for people looking to diversify and have another stream of income, people who are planning for retirement and need to complement their retirements. That's a big aspect in real estate investing. The third one is also very important, and it could probably warrant a webinar on its own, is the tax benefits. In the US, our tax system is very advantageous to investing in residential real estate investment. And we won't go into too much detail, but pretty much if you can defer all the capital gains you have for pretty much as long as you live, and not pay a lot of taxes. It's a benefit as the government realizes it's a driver of the local economy. And the last wealth generators is the loans that you can get on real estate are very attractive. At the moment, at the time this webinar is being recorded, you can get loans in the low 2s on securing a piece of residential asset, up to low 4s. So that's a very attractive rate. And those mortgages, and you have a unique product in the US, it's the 30-year fix, they're amortized. So over time, you are building equity without necessarily knowing it or realizing it. You are buying down that loan.
Perfect, Ben. We have a couple of questions in the chat.
Sure.
So what are the benefits and risks associated with the various residential assets? With the various residential assets? What are the benefits and risks associated with the various residential assets? Stefane asked this question.
Yeah, of course. I mean, so in any investment, you do have risks. So the markets fluctuate, they go up and down. Real estate is typically a much slower moving market than the S&P, for example, but it does go up and down. You do have risk as far as how much can you rent, and appreciation. So some of these would try and capture in pre-acquisition, try and quantify that risk. So, you know, obviously, if you have a piece of real estate in an area that's, we typically only focus on Houston because of that demand for lodging. But if you own a piece of real estate out in the country, there may not be a lot of demand to rent that. So then you're just relying on appreciation rather than cash flow.
Perfect. And to start, which one will be a good residential asset to start with when you're just starting in real estate?
Yeah, actually, that's a good question. That one I get a lot. It depends a little bit on your priority. So a small multifamily will have a tendency to produce more cash and can appreciate a bit less. So it's going to be more correlated to cash. Versus a single family, we'll see more appreciation because a lot of buyers look to buy single family, much less buyers buy duplexes, triplexes. So it also depends on what you favor. I think playing the appreciation game is more of a long-term wealth builder that you'll see over the years as your appreciation starts to kick in.
So you're saying the single family, like the small three bedrooms to bath, would be better to start with? Or those are actually the ones that are more difficult to start with because
both are fairly easy to start with. The single family, you do get better terms on the loan, so a lot of people do go for single family as their first investment. Yes.
And what is the other one that you mentioned?
The small multifamily, so duplex, triplex, fourplexes. Those will typically generate a little bit more cash than a single family. So they're attractive to people who value more the cash aspect.
Question on that one. If you're a new investor that you started, can you start with the small multifamily, or you have to have like an asset already? You have to have houses already.
No, you can go ahead and start off with a duplex. We had a client recently, that's his first asset. He purchased a duplex. Yeah.
Great.
Yeah, it's a great asset, and we'll see in some of the strategies, it's actually a very good asset to own as a starter, and we'll see in one of the business case later in the presentation.
Perfect, thank you.
Okay, well, these questions are a good segue to our next slide, which is what metrics you need to evaluate when you're looking at residential real estate investing. And there's mainly 3 metrics I definitely want you guys to have a look at every time you're evaluating deals. And you need to evaluate a lot of deals to get an understanding of where the numbers land and what market will bear. The first one is what we refer to as the cash on cash return. So that's the net operating income, and we put it in between brackets. The net operating income is the operating income of your asset minus the loan payment, and you divide that by the cash you put into the deal. That will create your cash on cash return. Some people you will see abbreviated as COC return. A very important metric, of course, because that can calibrate where you want to put your money. The next one that you see a lot is referred to as the cap rate. It stands for capitalization rate. So it's basically what does your asset return if you owned it full outright or with cash. So it's basically the operating income of your asset divided by your asset price. So that's a very good way to just look and see which asset produces more cash than another. So both these metrics are linked to how much cash the asset produces. The last one that's very important in residential, because we have that appreciation factor, is what we refer to as the annualized total return. Some people will also call it the IRR of a project, the internal rate of return, and that captures everything. So it captures your cash flows throughout time, and whenever you decide to sell it, it takes into account those gains and rolls it into a total return for the project. So that's a very important metric to look at. And on this, let's have a, yes, go ahead.
I believe we have a case study for this.
Yes, so we'll show you what we produce as an investment sheet, which captures this. Oh, there you go.
Do you want me to share? I can share as well.
Can you see this now, or maybe I need
No,
to
you have to go to share.
Yeah.
And there you go. Now we
see the case studies.
Yes.
All right, so this is actually a duplex. So going back to your question, as you see, it looks a little bit like the picture we showed you on the asset type, a single building with 2 units here. And this is how we analyze deals and put together for our clients. So you typically get these sheets, and on the top row is the summary of and we'll go into the analysis in a minute, but it's a summary of what the asset produces. So you see here, this asset has a cash on cash return on investment of just shy of 7%. The investor here in this case is putting nearly 100,000, and he's getting a steady income here of 575 on a monthly basis. And you see here again, this cap rate comes up. This is what the asset produces. So the operating income of the asset divided by its price. And then it spells out here the assumptions that we've put in this sheet. So you can see the purchase price, you can see the down payment the investor put, his interest rate at the time. And this is actually a real case scenario only a couple months ago. So this is very fresh numbers from what we're seeing in the market right now. And in expenses here, you can see the different allocations. Some are hard expenses, such as property taxes, HOA fees, and then some are more provisions, like we've provisioned here for maintenance. We've provisioned for a certain vacancy of this asset. So we'll put in non-cash expenses so that your projected cash on cash return and your projected cap rate is more accurate, and you know where you stand on things. Now, the last metric we talked about, that's very important. It actually goes on page 2. It's your annualized total return. So that's this line here, annualized total return. And you see it's broken out obviously by year, because it assumes you're going to sell the asset. So if you sell the asset year 5, which is typically what investors do, they hold assets for a period of 5 years, and then they decide if they should sell the asset and roll it into something bigger, or maybe refi the asset to keep the leverage up. But in this case, you'll see the annualized total return year 5 is 18%, and it gives you a projection. So you'll see that as time goes on and your leverage goes down because he's buying down the loan, that tends to go back to the cap rate. So that's, if you own the asset cash, that's what your investment is, cap rate.
We have a question in the chat. Sure. It's better to invest in short-term or long-term rentals properties for this type of deals, a duplex or single families? And yeah, what are the most crucial difference for a new investor?
Yes, I think that's a great question. Short-term rentals have been very popular with COVID. A lot of people working remotely, wanting to spend a few months in Houston. They will go ahead and do a short-term rental. So the numbers that we're seeing at the moment for short-term rentals, you do get a higher, on a monthly basis, a higher rental rate than if you rent on a year basis. You've got more variability in your cash flows, of course, because you're turning over tenants more often, and you've also got so more variability in that cash flow, and then also more work typically. I mean, you have to move in, move out people. Unless you can sort of short-term rental for a few months at a time, you can sort of go to the Airbnb model where that's actually a lot of work. So it depends how much work you're willing to put. These numbers here, they're based on a long-term 1-year lease. So these assets here, if we go back up, they both rent at $1,500 each, creating a monthly income of $3,000. Any other questions, Brenda, on the investment sheet?
Let me see. No, we don't. Not for now. Mm-hmm.
Okay. Well, I mean, I would like to hear from obviously people in the chat room what they think of this deal. Would they purchase this deal? how does it compare to based on some of the other deals they've done? If they've calculated some of these metrics, do they get the same cap rate, the same return on investments? Is this a deal that would be attractive to people? In this case, we did try and get it with the investor. Unfortunately, there was a lot of investors interested in this one, so we didn't actually get this property. So, but at least for the investor we're working with, he found this attractive.
So for someone, there is a question.
Sure.
So let's say for that deal, and it's a new investor, how much percentage they need to have on cash to buy? Because you see that an example, that's 98,000, but what if it's a new investor that doesn't have that cash? How much do they have to buy the first property?
Well, that's actually a great segue also to the next section, which is the strategies to start investing. So this investor here is a conventional investor who is buying a property with a 25% down payment. You could, on this one in particular, and we'll look at it, you could buy it as your residence, live in one unit and rent the other one out. And if you do that, well, then you can obviously put less money down because banks are more favorable to owner-occupied assets. So you can, on a duplex, you can go as low as 15% down. And then you've got other options too with financing. You can have a second lien that can pay a portion of those 15% down. That's also very popular. So a shorter second lien that you'll try and pay back, and that gets you to the down payment. So you've got different, if you're willing to be an owner occupied, you've got different ways to pull the cash. And a lot of people don't realize, but you also, especially if you've worked a few years, you've got a lot of access to cash that you may not realize. You can do line of credits against your brokerage assets, which enable you to, basically short-term borrow against those assets without having to sell the brokerage assets. So there's different ways, and it's on a case-by-case basis. We can definitely help the person understand their situation and where they want to be.
What are the expected returns in Houston real estate?
Yes, that's a very good question. Typically in real estate, you will see on the lower end, you'll see annualized total returns, probably around 15%. And on the upper range, you can probably see 40% annualized. So year over year. And you'll see some numbers in the business cases in a minute. Great. All right, let's go back and let's look, I guess, at this is a good question and a good segue to the next. What are the strategies to start investing? So we talked about it just a second ago, buying that duplex and living in one of the units. That's actually referred to house hacking. And house hacking can come in a lot of different forms, and I've seen it in a lot of different forms. Some people can own a single family home with a garage apartment. So an apartment above the garage that they rent to a student or to a younger person. It can be a small multifamily where the owner lives in one unit, rents the other ones out. It's renting a portion of your assets. So some people live in the house, rent the land out. Some people rent bedrooms out. And that's actually our case, you'll see in a minute. I've seen the ultimate house hack only once. So the ultimate house hack was somebody who owned a single family house, leased out every bedroom independently, and they lived in the trailer in the backyard. So that's kind of your ultimate house hack there. And this strategy, I understand it's not for everybody, but it's definitely a strategy that's worth talking about a little bit. Especially if people are interested in the heights, owning a house with a garage apartment, very common, or building one yourself too. So in this case, this is a house hack business case. The owner purchased a townhouse in the center, and he had 3 bedrooms. Each bedroom has its own bathroom. He didn't rent out both bedrooms. He just rented out the bottom bedroom while he was living there. And you see, he held the asset for 6 years. And when time came to sell, you'll see just here at the bottom, I'll highlight it. He got an actual IRR, or actual total return, annualized of 32%. And then you have some more metrics here that will help you if you're trying to understand investments. You know, he saw a vacancy, an actual vacancy of 5%. He purchased something fairly new, so his CapEx and maintenance budgets was only 1%. So this gives you an idea of this kind of return, so a return in the 30%. You'll also see in a lot of real estate investment sheets, you'll see equity multiple. Equity multiple is just how much money did you put in, what was your equity, and when you sell, how much equity do you get back? So in this case, he 4x'd what he put in a period of 6 years. All right.
Question: what are the rules and regulations for this type of business, like house hacking in Houston? Is there any regulations, things that you can do? Do you have to need a permit to do house hacking?
No, you don't need a permit for that. For Airbnb, you do need different permits. But if you do short-term rentals, I believe above a couple of months, you don't need that permit. So the permits come with short-term. The house hack doesn't need any sort of permit. All right, so if house hacking is not for you, which, listen, I can understand, you may not want somebody living in your house while you're in the trailer. Another very popular way to build a rental portfolio is what we call house hopping. So you buy your home and it's your homestead, and you get it with very attractive terms. You can put 5% down and get, you know, a 3% loan. You live in it a bit, and then you buy another house for yourself, and then you turn in your original house into a rental. So basically you're hopping houses, and every time putting very little money down and getting attractive loan terms. So that's a very popular way to build, you know, and typically people will do this in a 6 to 1 year period. They'll live in there for 6 months, a year, and they'll house hop. And the advantage of this technique is you're always leveraging these owner-occupied loan programs where you don't need that as much money down, and your interest rate is pretty attractive. So what if, I guess you're like the investor in that investor sheet who loves his house and he doesn't really want to do house hacking, which I can also very much understand. Then you go to something a little bit more traditional, which we refer to as the buy and hold, which is just typically acquiring an asset as an investor and renting it out and holding on to it. So we do have a case study on this one that we published a few months ago. Once I got all the numbers. So this was a little 3-bedroom, 2-bath house in the energy corridor. This type of rental asset attracts a lot of young couples looking to put their kids in daycare. There's a lot of daycares in this area. And you see, you know, he owned it about, well, 4 years only in this case. And let's look here. And this gives you some actual metrics, again, if you want to calibrate that sheet in pre-acquisition. So he saw an average yearly appreciation of 9%. And a good way to see if, so in Houston, we've appreciated, the last 15 years, we've appreciated on average 5% in the Metroplex. So some areas have underperformed that, of course, and some areas have overperformed. This area did obviously overperform. How do you find those areas that overperform? They're usually the ones where the city is investing a lot of money, or they're being pulled by a neighborhood very close to them that is appreciating. So for example, the Heights has appreciated a lot. Now people look at the neighborhoods around the Heights as being pulled up by the Heights. So Independence Heights, Northside Village, sorry, all those are close to the Heights, and they're forecasted to be pulled up by that appreciation. So there's always a leading neighborhood, and the other ones sort of follow and trickle over. But you'll see here an average vacancy of 2%. This was pretty much ready to go, but he did update a little bit visually, repainted and that sort of thing. So he's got an average CapEx budget and maintenance of about 3.5. and he was making on his cash about 8.8%. So when time came to sell, again, this equity multiple. So in a period of 4 years, he more than tripled his initial case. Any questions on the sort of buy and hold strategy?
There is a question in the chat. Why buy single family, townhomes, or multi?
Well, it goes back to the wealth generators. You get tax advantages on those, and you get this appreciation that you may not in a commercial asset. And it's usually a very easy step. A lot of people understand lodging versus maybe a commercial asset, which is storage or office buildings. Maybe it's less understandable. It's more liquid too, especially when you're in a big metroplex. If you have a single family home here in Houston and, you know, for any reason you're not happy with it, within a few months, we typically can unload that asset. You know, if you own a big building in downtown, it's going to be much harder to sell. So it's usually a very easy first step into investing. A lot of investors start with residential. And I think those are some of the benefits there.
So as a new investor, what type of strategy he should start with?
Well, I guess we saw a couple, which could be the house hack, which could be the house hopping. But buy and hold is a very popular strategy. All those are sort of lower risk strategy. The last one we're going to look at is higher risk. A lot of people don't necessarily start with that last one, but these three that we just talked about are very easy, good starting strategies. Buy, hold, and then the other house hopping strategies that we talked about. So I guess let's look at the last one. And the last one, there's a lot of online information about this. It's buying, rehab, and refi. Some people refer to it as BRRRR. It was made popular by Bigger Pockets. We'll just go through the mechanism, and I'll talk to you a little bit about what can go wrong in this strategy, because a lot of investors have gotten it wrong. We do help investors with BRRRRs, and we'll show you a business case of one, how it's applied. But it is a higher risk strategy. So typically we acquire an asset that needs renovation. So we'll go in and renovate it. After we renovate it, we place a tenant there, and we have to wait at least 6 months before you can refi that. And when you refi a rental asset, you can pull out 75% of the appraised value. So we refer to that as the after repair value. And if you do this correctly, in theory, you can pull out all the money you put in. And that's why it's very popular on the internet, because they talk about infinite return. You've pulled out all the money you put in, and then they say you can take that money and do it again. So that's where the acronym comes from: buy, rehab, refi, rent, and repeat, basically. However, in real life, it doesn't actually work like this. There's a lot of variability in these steps. One of the biggest variability is your renovation cost and time. When you start renovating an asset, you open up something, you are bound to see other things. So you've got natural scope creep, and then you've got scope add-ons. You realize a pipe is leaking, well, everything's open, so you may as well fix it. And so you get a lot of scope creep, you get a lot of delays. At the moment, we've got a short supply on materials. We did a BRRRR recently. We had ordered beautiful engineered floors from Asia, and the boat kept on being delayed. And so after a couple of months, we couldn't wait any longer. And so we had to change materials. We went for a tile product that looked like wood. It came out great, but it was a change, and we had to react. So this kind of variability is very common when you're doing renovations. The other variability The appraised value, so the after repair value, we obviously estimate it based on the comps that are out there. However, it's decided by an appraiser. And a lot of appraisers, since the real estate crisis of 2007, 2008, are very skittish. So if they see that you've purchased that property for, let's call it 300,000, they walk in, they see you've put maybe 30, 40,000, you know, they're not going to determine that that asset is worth 400,000 6 months afterwards. They're going to, you know, estimate the values of repair and maybe add a little bit more. So maybe you're hoping for a low 400 appraisal, and it should be based on the market. However, the appraiser is not going to take a lot of risk, and he's going to say, well, maybe it's high threes. And so then your BRRRR does not exactly work out and perfectly, where you're pulling out all your investment. You're having to leave some money in the deal. So that's some of the things that can go wrong. I'll show you one BRRRR that we did with an investor, and we'll talk about what he did in this case. So I'll show you, I'll start by the pictures. The pictures are always more interesting. So you can see the before and after pictures of what we did here with him. So there was a wall, we opened all of that up and changed all the flooring. So we definitely improved the property. And so this investor purchased this one in 19, 182. He put a substantial $60,000 on renovation. And all of this is he decided to use cash. He did not take a hard money loan or a regular loan. So he's in it for 241. Now, what did he do? He didn't refi it 6 months afterwards. He just waited. We just waited until his asset appreciated or until he had another project. And that's what happened earlier this year. You see in April 21, he decides to refi this and gets an appraisal of 325. And 75% of that yields 244. So he basically pulled out all his cash in this one. And I say basically because you've got some loan fees. So it might have been just shy of his initial investment. But he did hold the asset for 2 years before that happened. And you can refi it earlier. He just would have pulled out less cash. But that gave him, basically, if you calculate, that gave him a forced appreciation and natural appreciation. I think we can't discount there's been a bit of a natural appreciation. He's got an average of 24% year over year. So that's a real life case BRRRR. And a lot of people confuse BRRRR with flipping. BRRRR is holding the investment, so it's becoming an investor. Flipping would be to resell the asset, and that's more working in real estate and creating real estate income. So that's kind of the differentiation between the two. Any questions on BRRRRs and that variability that we see in real life?
Can you explain a little more about BRRRR and flipping? Can you give us examples and a little of options, differentiate?
Yes. So basically, the difference between a BRRRR and a flip is once you've renovated it, the flipper is going to put it back on the market for sale. The person who wants to hold this as an investment is going to find a tenant and refi it. Investment is about holding assets. A flipper doesn't hold assets, or at least not for a very long time. He flips.
So a flipper makes less money than an investor.
Not necessarily. He makes maybe more money right there and then, because you know, in this case, I'll go back to well, I won't go back. But if you sell and you sell at the right price, you're making, you know, that equity 100% of what the aftermarket value repair is. Holding the investment is banking on appreciation. You're going to have the wealth generators we talked about. So you're going to have tax benefits. The flipper doesn't have tax benefits. He's going to be taxed on his marginal rate. So the benefits we talked about in owning real estate, the flipper doesn't see that. He's very much working in real estate. So he might make more, but he doesn't have the benefits that holding the investment would yield, which are appreciation, tax benefit, and then buying down your loan.
Got it. So I have a couple of questions in the chat.
Sure.
Should I buy my rental cash or finance a portion?
Okay, that's actually a very good question. And there's two schools of thought. If you look at Dave Ramsey, for example, he's a very big advocate of buying rentals cash. And then you see a lot of other sort of investment gurus that talk to you about leveraging. So when you do take a loan, you're leveraging. So you are magnifying your returns. As you saw in the investment sheet, the first investment sheet we did, the cap rate of that asset is 6%. So that's if you own it cash, you're getting 6%. And you're getting great cash flow. You're getting $3,000 of cash flow right in your pocket minus the fees of the property. However, when you're leveraging, you're basically borrowing money at a lower rate. You know, call it at this time, the investment sheet says 3.75%, and you're actually making money at 6%. So you're basically making money on money you don't own. So then it magnifies your returns. And so that's where you get the sort of 20s and 30% returns that you see in real estate. It's by leveraging. So a lot of investors leverage. Yeah, that's how you boost up your return. Now the disadvantage in leveraging, and that's why David Ramsey advocates cash, is it creates more risk for you. So if your rental asset does not rent, you're now having to carry another mortgage payment. And that's what makes it difficult in rentals. The first and second rental are the most difficult, but once you start hitting 3, 4 rentals, they all balance themselves out. And so it's a matter of acquiring several rentals that create several income streams, and then also having the cash reserves for those rainy days. So it's risk management.
If I'm starting out and I'm not sure how to map it out, what would a common 10-year plan look like for real estate investing? That's another question that I found in the chat.
That's very good. Yeah, so we work with our customers to establish a plan. Real estate is very much like going to the gym. It's a steady, consistent approach will yield very good results on the long run. It's not a get rich fast method. So having a plan is very important. And we typically sit down with our clients and we have a template that we go through. And I guess if you want that template, we can send it to you if you want to put your email in the chat. And we sort of define a plan. So one of the very standard plans, and all of them are published on internet. As I said in the beginning, and this is as real estate investing is as old as time, really. So we typically have 10-year plans where we attempt to buy an asset a year. And then when you reach year 5, your first asset has appreciated. And that's when it becomes, your plan accelerates, because you either refi that asset or sell it, defer the capital gains, and start buying 2 assets a year. And so the plans that we see are very much exponential. You sort of buy a few assets initially, and then it sort of grows exponentially. And so by a lot of these plans, by year 10, you pretty much create a passive stream of income net, and it varies by people, but you'll have between $5,000 to $7,000 of net cash flow if you stick to the plan.
Perfect.
And I think that concludes the strategies. Yes, and that concludes our presentation. So again, Brenda, yeah, if you've got more questions, we can definitely take those. But yeah, that was all the material for today.
Yeah, I think we covered all the questions, and
Great.
we have a couple of emails that we're going to be sharing the templates on. And if you're seeing this webinar after they're not live, because we're recording this webinar and we are going to share it, where they can find the template if they didn't have the chance to share it here.
I guess on our website, we have a learning section where you find some more material to learn. I think we've got some blogs, and we'll probably post this on the website. So I think all will be downloaded or downloadable on the website.
They can connect with you on LinkedIn. They can find
and
you on LinkedIn.
yes, of course. I mean, my LinkedIn's open. You can. There's not a lot of Ben Plouviers in Houston, so you can connect with me on LinkedIn. Just above here, you have my contact information.
Yes.
You've got the company number. You can call the company. Someone will pick up, or you can send me an email directly with some follow-up questions. And happy to schedule a call if you have specific questions based on your case.
And we do have a last question about the template. When
Yes.
you do the template with customers, do you take their personal income and available funds into consideration for the plan?
We do. We look at where people stand currently financially. We talk about where do they want to be, and we devise a plan that is sort of tailored to their situation. So we have several customers looking to, complement their retirement in a sort of 10 to 15 year horizon. So, we definitely take that into consideration and build projections on how we think we could go about that.
Perfect. Sounds like a plan. Thank you, Ben, for really putting together this webinar and teaching us about real estate investing.
Yeah, well, thanks for putting this together, Brenda.
Thank you. Thank you. We are going to stop the recording now. We are going to have the link available in the website. So check the website in a couple of days, and it's going to be available for you to download it as well. Thank you for everything. And everybody's saying, thank you, Ben. Glad I saw this pop out on my feed. Thank you. So thank you. Take care and have a great day.
Thanks.
Bye-bye.
Bye.